Hi, everyone. This is Jason Burek of Wall Street from Main Street.
And this is Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 19. Lee, we're recording the show on Wednesday night, May 10th, 2023. This week, we had the Consumer Price Index, or as I call it, the CPI, or Changing Propaganda Index. The base effects are finally starting to catch up with a higher price floor, but that doesn't reflect reality, does it?
No, it definitely does not. The CPI never does, but it certainly had an impact on the market today. We had a rip in the beginning, and then they blame it on whatever the news is going, and then it pulled back. But we'll see. I think there's justification now for the Fed to cut back on their rate cuts, and maybe even think about rate hikes. I'm sorry, and maybe even think about doing a cut or two in the near future.
But I would argue, Lee, that the damage is already done. We'll talk about this throughout the show.
No doubt about that, Jason. No doubt about that.
Yeah. And for listeners out there, we've now had over 12 months of a rapid increase in interest rate hikes that the banks, the insurance companies, the private equity guys, commercial real estate were not used to. And unfortunately, it looks like the excrement is about to hit the fan in the not too distant future. So the warm up, just the first inning of the commercial real estate crisis. Actually, Lee, we've been seeing news stories come out. It looks like European commercial real estate is going to implode even faster than US commercial real estate. But first, let's talk about some of the warnings with the interest rate hikes. So the Fed has increased interest rates, a lot in the last 12 months. Now, the common perception out there that we hear all the talking heads on podcasts, on mainstream financial TV talk about is that a steepening yield curve is good for the banks. Well, it doesn't look like that, does it?
No, definitely not. I mean, we were talking before we started recording that the banks aren't really in that model anymore. I mean, they're really, they kind of operate like a hedge fund, I would say. They're borrowing short, they're lending long, and that's just not going to work in an interest rate environment that where the interest rates are rising, and that's the environment we've been in. And I think they're in deep trouble, and I think we're seeing it in the regional banks. We've been seeing it since I think January, right? We started January, February. We started to see Silicon Valley Bank and other regional banks get hit hard.
Well, I actually saw something really funny on a Blockworks macro discussion on one of their YouTube interviews. They were interviewing banking expert Christopher Whalen, and the stuff I highly recommend you go and watch some of the interviews and podcasts Christopher Whalen has done. He's more of a mainstream bank analyst, and he straight up said some really controversial stuff. And the mainstream financial talking heads that are interviewing him on a lot of these interviews just had a full meltdown. He said recently, according to a new FDIC report, he said basically the entire US banking system is either close to or already insolvent with the rate hikes. He said that the entire US banking system is sitting according to his calculations, and this guy gets paid a lot of money over the years, over his 20, 30 years career in banking and covering bank stocks. He said that the entire US banking system is sitting on at least $5 trillion in losses that they haven't marked down yet. And he's talking about how a lot of these large banks need to do emergency capital raises to fix their balance sheet. Meanwhile, you hear the Fed apologists. So I won't name names, but these are highly paid people that either used to work at one of the Federal Reserve banks, or they're closely connected to the Federal Reserve banks, or they were a bank analyst on Wall Street covering bank stocks. And they're coming out saying the banks are okay. They don't have real losses. They can just hold their bond portfolios to maturity. Well, we saw with Silicon Valley Bank, we saw with Signature Bank, we saw with First Republic Bank, that these regional banks in particularly, they can't just hold everything to maturity, especially if they have depositors' funds leaving. They have large losses on their mortgage portfolio. I think First Republic Bank gave out enormous amounts of jumbo mortgages to lots of customers at 3%. Well, in a higher interest rate environment, they're underwater on those loans. They're underwater on their bond portfolios. Like you said, I've heard one bank analyst, another bank analyst basically say that a lot of these banks are basically leveraged bond funds.
Yeah, of course.
So if you own a massive bond portfolio with leverage, even if it's not with leverage and they're older bonds and the Fed is raising interest rates at a record clip over the last 12 plus months, I mean, you're going to have large losses on those bonds. You cannot hold all those bonds to maturity, especially if you have balance sheet problems and need to go raise equity capital.
I saw an interview with Michael Milken, and I saw one with Kevin O'Leary, and they were both kind of blaming the regional banks and the management. And I'm sitting back thinking, like, no, not really. I mean, they're kind of forced to do what they have to do just to survive with the way the Fed's been. The basically zero interest rate environment for a long time. I mean, they need yield. They need to make money. So, they were kind of forced into taking more and more risky investments along with everyone else. Pension funds. I mean, it's and you look at almost every industry, Jason. It's become fewer and fewer players in it, and larger players, and it almost looks like it's just an intention thing in the banking industry, where you get the big JP Morgans coming in and taking over the assets of these smaller players. I mean, they did that in the 80s with the savings and loan crisis, and I don't know. I think the band marches and the band plays on, and then we march forward in this crazy world.
Lee, this is way larger than the 1980 savings and loan crisis.
Oh, no doubt about it. No doubt. Just using that as an example, like it's a pattern that repeats itself and gets worse and worse and bigger and bigger.
Well, also back then, senior bankers, I believe senior banking executives went to prison. So that was probably the last time senior banking executives actually went to prison, that the government, the U.S. federal government, the Department of Justice was actually prosecuting under existing laws. So that was really the last time. And there was a mutiny on Wall Street. So there was a mutiny on Wall Street with the interest rate hikes, with Paul Volcker raising interest rates that high. There was a mutiny also when senior bankers started going to prison during the S&L crisis. And really, a lot of that has stopped. But you brought up a great point, and this is the Austrian theory that I think we're seeing a textbook example of the Austrian theory of the business cycle playing out, because we had the artificial boom with artificially cheap capital, with artificially cheap interest rates. And so that created a Pavlovian response to these bankers, these hedge fund managers, these large corporate senior executives running that are chief financial officers and the accounting department. And in all of their Microsoft Excel spreadsheets, their modeling, they did not make the assumption that the Federal Reserve Bank would raise interest rates quickly, and that their cost of capital would go up, their interest payments on the debt on the balance sheet would go up, their loan portfolio would be underwater, their bond portfolios would have enormous losses. And now here we are after the artificial boom with the interest rate hikes. That's the pin in the bubble. That is the bust. This is a textbook example of the Austrian theory of the business cycle, with the interest rate hikes in rapid succession being the bust to the bubble here. And I think, unfortunately, the pain has really just started with the banks. I actually had yesterday, on Tuesday, a conversation with a banker at a large bank. It was off the record. And the guy sent me charts and Excel spreadsheet models, stuff I'm not allowed to publish, by the way. But basically showing me that the entire U.S. banking system, after all these rate hikes, the inverted yield curve, depositors leaving regional banks, the losses coming on commercial real estate that are not written down yet, bond portfolio losses that are not written down, that almost the entire U.S. banking system is insolvent now.
Yeah. Well, it's there's so many shoes that could drop anytime in the next 6, 12, 18, 24 months. We talked a little bit before we started recording about the auto industry. And this is a direct effect of the lending, the interest rates. The dealers are loaded with inventory right now. And the auto manufacturers have kind of been playing a game, forcing all their inventory on the dealers. So the dealers are sitting on it, and no one's buying it because the interest rates are high. Eventually something has to... Yeah, something's got to change. I mean,
let's also talk about the buyers, so the demand side for that too. So you're talking about there's an excess supply now, and the average person who wants to buy a car with the loan, they're looking at a much higher interest rate. I mean, I think before the payments were $1,000 a month for some of this stuff. But on the demand side, Lee, I mean, if you're a consumer out there, there's not a lot of people out there able to grow their income. A lot of people are losing their high-paying jobs now. Look at big tech. You sent me that article on big tech firings. Yeah. I mean, the stocks for the large cap big tech stocks. So the handful of companies, so your Meta, Facebook, Google, Apple, Amazon, those ones have been basically carrying the stock market up, propping up all the rest of the stocks, especially the small caps, are just making lower lows and look like they're about to roll over again into another bear market and crash.
We get into another issue here with cars. The average new price of a car is $48,000. I mean, that's a lot of money for your average person. If you're making 100K, that's half your salary for a year.
Yeah, but who's paying cash up front? Who's paying cash up front for that?
No, you're not. But you're forced to take. I mean, just the payments alone. I mean, $48,000, half a year's salary. That's a lot of money to pay for a car. And the during COVID, there was such a shortage of cars in the both new and used market. It's not the case anymore. And my understanding is the car dealers are not paying what they were for trade-ins anymore. So it's even less affordable than it was. You add to it the cost of everything that's going up. Like I mentioned to you before, I ordered Chinese food last night. I for two people, it was $50 for takeout. Like, it's crazy,
And people just don't have consumer discretionary income.
No,
I mean, Lee,
absolutely not. Yeah.
You were just telling me some of the anecdotal stories about the construction industry, commercial real estate in the New York City metro area.
I spoke with a gentleman the other day in construction management, and he's in the public sector, and he's in pretty good shape because of that. But he said all his friends in the private sector, construction, are just calling him looking for any kind of work because there's just nothing out there. It's. And by the way, one type of auto car demand has increased significantly, and you know what that is? Bulletproof cars.
Oh, is that for like the Davos people? Is that for the Davos people?
Well, it's not for your average Joe, that's for sure. But
it's okay. The Davos people will buy carbon credits. So even though those bulletproof cars are heavy, right? And I doubt they're buying hybrid bulletproof vehicles or electric bulletproof vehicles.
Probably not. And we were talking about interest rates, and one statistic I found, the mortgage rates of the cost has increased 85% in just 3 years. So that's just another area. People are getting squeezed, man. If you have an adjustable rate mortgage, can you imagine? Ouch.
And look at the debt. Also, not only is the consumer strapped with debt, look at the interest payments people are paying on credit cards. Their savings are being drained. So people are paying sky high. The credit card balances, I think now outstandingly, are over $1 trillion. But look at the corporations. I mean, these corporations, it was also a Pavlovian response by a lot of these large corporations for the last 15 years with artificially cheap credit, thanks to Federal Reserve Bank quantitative easing and zero interest rate policy, or close to zero interest rate. So if you're a large corporation or medium-sized one, especially publicly traded, because those guys have easier access to capital markets, so they would borrow even more capital. And now with higher interest rates, they're looking at much higher interest payments on the debt. So that's going to take away from free cash flow. And then also, like, if they're depending upon their product or service, the businesses or consumers may be cutting back on that. So the valuations for a lot of these stocks are not justified, especially if these companies don't have the free cash flow anymore and they have to pay off debt and clean up their balance sheet.
It's going to be interesting to see what happens in the markets, the equity markets. I mean, I've been following it pretty closely. Anytime I see like a potential significant change in the market, I've been posting in my community board on my channel. And, I called the last rally. Right now I'm looking at everything, and I don't know where it's going over the next couple of days or a couple of weeks, but inevitably I can't see them unless they start printing money like hand over fist again.
Well, Lee, even if the Fed cuts rates, I think the damage is already done. So I think
no doubt about it.
I think the damage is already done for a lot of these companies. The damage is already done for the banking system because a lot of these banks are in balance sheet peril. As I was talking about earlier, Christopher Whalen's going on public interviews on Bloomberg Radio with Hugh Hendry and talking about the latest FDIC report, the data from the FDIC saying most of the U.S. banking system is already insolvent. You should have seen the face. They had video of the podcast where Christopher Whalen called in of the talking head that was asking these questions. The moderator, his jaw just dropped. He didn't want to talk about it anymore.
And by the way, I just looked up an interesting statistic. There's $986 billion of credit card debt outstanding.
It's close to $1 trillion. And that average interest rate, Lee, is around 25%.
Yeah.
If you have a balance, so you're paying 25%.
Yep. And if people aren't able to pay that number is going to balloon up because it's going to be a lot of people not able to pay at the same time.
And a lot of people have $1,000 a month car payment. Rent is high. Healthcare insurance premiums are sky high. If you go to the doctor, and the visits for the doctor here in the United States, with the corruption in our healthcare system, it's just a mess. I mean, I don't know how the average person is able to maintain their standard of living with inflation, taxes, currency debasement, shrinkflation, all these costs going up, that the changing propaganda index lies or obfuscates about.
I think one of the biggest shoes yet to drop, and I've been talking about this now for a couple of years, is commercial real estate. It's just, problem is that we shifted culturally. People aren't going in the office, and it's been, I think it started before COVID, but COVID really accelerated it. There's a vacancy rate in San Francisco about 30%, and New York, I think it's about 17 or so. But the issue is, there's a lot of companies that have space, office space, that they're renting, but no one's using it. And eventually, when their leases are up, they're just not going to renew them. And it's going to be this huge wave of just complete, like, move away from commercial real estate. Like, I mean,
well, not only that, Lee. I mean, look at the pension funds. The pension funds have enormous amounts of investments in bonds, in private equity, in commercial real estate. They haven't taken any real losses on any of this. There's been no mark-to-market write-downs from insurance companies. Insurance companies are sitting on, I don't know the exact estimate, but it has to be over 100 billion in bond losses. So all these large insurance companies, they've been the average listener probably doesn't understand this, but the U.S. government many decades ago required that insurance companies hold a lot of their insurance premiums buying bonds. So they have to buy U.S. Treasuries, they have to buy other types of bonds, because these were viewed as quote unquote safer, except in an interest rate hiking cycle environment. Because if the Fed's going to rapidly increase interest rates, all those older existing bonds are all big losers. And if the asset holder, so if the insurance company is doing risk parity, the bank is doing a leveraged bond portfolio, then the losses are even larger on the older existing bonds.
Yeah, pensions are another big shoe to drop, as we've talked about a couple times. I did see that they're pulling away from the large private equity funds. I don't know where they're going to be allocating their capital. I don't know whether they're moving to maybe more middle market private equity, or they're looking outside of private equity. I can't imagine they're looking in the real estate sector right now.
Well, pension funds?
Yes.
So yes. If they actually have cash, I mean, they could go to U.S. Treasuries right now and they could get a quote unquote risk-free rate. The problem is that's still below the consumer price index. So it's not a real return then, and you're paying taxes on it. So you're getting a nominal return that you have to also pay taxes on. And I think that's why the foreign governments, so these foreign central banks, not only that, with the confiscation of the Russian reserves, over 300 billion, they're saying, hey, look, everyone's advertising that U.S. Treasuries are quote unquote risk free, but that's still below consumer price index, the official government inflation rate. Why should we buy all these U.S. Treasuries when the U.S. government could sanction us and it's still below the consumer price index? We need to diversify our foreign exchange reserves, and we need to diversify that into physical gold tonnage. So it's really these and I don't see that trend going away. So if the paper gold price is smashed over the next couple months and it drops $100 or $200 an ounce or something like that, I think these central banks that are outside the G7, I think they'd buy even more.
Do you foresee pension funds investing in that sector?
No, I think pension funds are heavily politicized. I mean, I just read these articles that these pension funds are suckered on these sports stadium boondoggle deals. So a lot of the times, not only is the local government taxing a lot on tourism and local residents, extra sales taxes to fund these giant boondoggle sports stadiums, but the pension fund is also the one who's investing in it for bread and circus purposes. And you go back decades on these pension funds investing in these sports stadiums. I mean, these pension funds, a lot of them just have losing investments across the board. It's really sad.
I was scanning pension investment news, and like almost every other article's on like ESG investing. I'm just like, oh, do these guys actually fall for this nonsense? Are they forced to do it? I can't make heads or tails out of why people would invest in this.
So
I think
the best example I use for dumb pension fund investing happened about a little over 12 months ago, you had the Ontario Teachers Pension Fund, and they had a portfolio of cash flow royalties and streams on a lot of good mines long term. They sold the portfolio of cash flow royalties and streams, about 10 of them, this was partnered with Glencore. They sold it around 1x cash flow to Sandstorm Gold, I think, for around $500 million. And then guess what they did with the funds, Lee?
What did they put it in? I'm afraid to ask.
It's unbelievably tragic. They bought in right at the top around $400 million.
Don't tell me Bitcoin, please.
No. It was even worse than Bitcoin, into FTX directly. It was directly into equity ownership FTX.
Oh.
This was the Ontario Teacher Pension Fund, and apparently it was through a couple subsidiaries. So I think the main pension fund managers might not have even have known about it.
Yeah. Jeez. Crazy.
And so this was around February, the Super Bowl 2022, as that stuff was starting to play out. So this was this was right at the very top of Bitcoin. So they sold all their royalties and streams that will throw off free cash flow for decades. They sold it to a smart royalty and streaming company that was thinking long term, and then they went and chased crypto, and they stupidly put about $400 million into FTX directly into equity ownership.
Yeah, and so I think Sam Bankman-Fried's still out there, right?
I don't know. I stopped paying attention to that. I mean, the new one, Lee, is the CZ Binance. So that's the new one where all the red flags are, because I think they halted earlier this week Bitcoin withdrawals, right? So that's the one where there's the official backstory is he escaped China, mainland China, with his mother and moved to Vancouver. But some of my hedge fund and U.S. intelligence contacts have told me that that's not his real backstory, and that he set that crypto exchange up with a lot of funds from Chinese billionaires and other Chinese Communist Party people who wanted to help launder a lot of their stolen gains outside of mainland China.
Okay. Oh, boy.
Well, I mean, the U.S. government, there's all these, they have email transcripts from people in CZ Binance saying that they don't care if terrorists buy a few AK-47s with some of the currency that's longer. So, they're not doing a good job there as a publicly traded company that has to deal with regulators. I mean, I'm obviously, as my listeners know, I'm not in favor of the government and regulation and stuff like that. But if you're operating an exchange, unfortunately, to play ball, you have to comply, especially with U.S. customers, with anti-money laundering laws, which I think are stupid, but unfortunately they're in place. The compliance costs and all the rules, regulations, red tape add many millions of dollars per year to overhead, and then you have the know your customer rules.
Yeah, I know. They don't pass those kind of regulations to help the small guys. Those are all designed for the big companies. Well, because they can afford teams of accountants and attorneys to just make sure that they're compliant with everything. Your smaller companies cannot deal with that. And that's across every sector, from finance to manufacturing, etc.
Well, the big governments that have too much power and control over people's freedoms in the economy. They want to monitor all of our stock exchange portfolios. They want to monitor all of our bank accounts, and if things don't match. So if you report on your taxes that you're not earning very much money, and all of a sudden your stock portfolio is worth $5 or $10 million, they want to know why. So that's, and then I mean, central bank digital currencies are just hijacking blockchain technology and creating a centralized database to track and tax every transaction. Then they could put in new taxes on each economic transaction that you don't even have to elect elected officials in Congress for those taxes or other stuff to be implemented.
It's really terrifying, the whole thought of central bank digital currency. It really is. It's something that's something that actually keeps me up at night sometimes, because it's not that I'm doing anything wrong. I just don't want them to see every transaction, and I don't want them to be putting us in a position where you have to spend your money or you lose it. You know.
Well, you're going to lose it long term. So the longer you hold fiat currencies, the more they're going to be debased.
Yeah. Well,
so
that's why you want to hold assets.
Yeah. So I mean, they're not going to maybe directly confiscate unless they force people's retirement accounts into U.S. Treasuries, similar to kind of a war environment. So the governments in the past, if you're not familiar with financial history, I'll just give a brief summary. What governments would do in many different countries is, even though the citizens didn't want to fight in the war didn't want to pay for the war, the governments would say that, well, you're funding the war and you have to buy these war bonds, or you have to pay for some type of funding for our military. If you're, that's assuming that like what the younger men weren't going to be forced in a draft to go into the war and die. So they would tax you and fund the war anyway, whether you wanted to or not. And the war bonds in the past through many different governments would just be inflated away. So they'd be at a fixed interest rates. Yep. There'd be a marketing scheme, and then the government would just inflate the war debt away. That's what historically happened.
Yeah, I mean, they really have no choice because war is a very expensive proposition, and we certainly have spent an awful lot of money on that. But
there's a war on the climate, Lee. They need to fund these. They need to fund all that ESG spending. They need to put an electric vehicle in every garage, 2 electric vehicles in every single garage. I remember
maybe it was AOC said something about like we should be spending what we spent in World War II, like equivalent GDP percentage on this whole climate stuff. I'm like, oh my God.
I think she wants to spend like 5 trillion or 10 trillion. I mean, that'll multiply her net worth. She'll go from over $5 million in her net worth in under 5 years of Congress. She'll go to 20, 30, 50 million. I mean, it's not Nancy Pelosi money, but it's pretty good.
Probably the best job in the world you can get is being a congressional, either in the House of Representatives or Senate.
Well, the energy spending grift, ESG is what I call it, and well, ESG is energy spending grift or energy unlimited. Well,
it's not just energy; it's the whole social component, and that's why a lot of these companies are going the way they are socially, and pushing certain agendas. It's certainly not helping them. I think we saw a pretty good recent example of that, but we shouldn't talk about that here. So,
well, the other thing is, Lee, I think this is going to still exacerbate all of the supply side problems we've been talking about on these shows, on our Finance Unspun shows for over a year now. There's even worse supply side problems in oil, natural gas, uranium long term. There's a lack of cheap energy and cheap electricity. Yeah, energy prices are weak now, but a lot of those companies are cheap and they're hated. And so long term, I think even though we had high energy prices for over 12 months from 2021 and part of 2022, I mean, there was not a lot of investment. We're seeing now, we're seeing a lot on its own. We're seeing a lot of OPEC plus countries. The April survey numbers are out, and their production data is falling still on its own. So there may be more OPEC cuts, but there's just not going to be the investment required, especially if they're going to force a lot of electric vehicle switches over from an internal combustion engine. You need a lot of cheap electricity. There's just the infrastructure of the U.S.'s electrical grid can't handle it, can't handle people plugging in. I think in California, I think there's already laws in place now because they try to force a lot more electric vehicle conversion in California, but then it overloaded their grid. So you can't even plug in your electric vehicle to charge to go to work during certain time periods.
Yeah, it's very interesting. Ford announced that they're going to be bringing a gas-powered Ranger in the future. So I don't know, maybe auto manufacturers are getting the hint that the whole electric car thing may not work out long term.
I think the hybrids are better. I think the hybrids are the most efficient, but I think Toyota might even be phasing those out. I mean, a lot of the car manufacturers are not going with the hybrids. I think the hybrids are a good kind of middle path solution here.
I have to say, Jason, I owned a Prius at one point in my life and got good gas mileage, but man, I had to fill that tank up constantly. I had a 9-gallon tank. It was crazy. I'm like, I spend more time at the gas station anywhere else, and I never thought that would happen with the hybrid. So yeah, they're not perfect cars.
I'm not a fan of the Prius. I mean, I think they could build a better hybrid.
Yeah. Well, hopefully technology increases. I mean, I have no issues with technology as long as it works. But what I do have a big issue with is when you have regulators, governments trying to force certain technologies over others. I mean, we're both free market guys. I mean, we want the market to decide what's best in the consumer.
Well, it's tough to do that when governments control these national oil companies, control over 70% of global economic oil production and the world's oil reserves. But then also you have all these policies that are anti-oil and natural gas drilling.
Yeah. Oh, and they also regulate the heck out of the auto industry. I mean, cars are very expensive, and part of that is all the regulations that are thrown at them.
So, Lee, we have a couple more points here for this shortened show for Finance Unspun. I wanted to bring up the FHLB loans because if my listeners go back and go and listen to the great interview I did a couple weeks ago with John Titus of Best Evidence, he's talking about the FHLB. And actually, one of the global macro podcasters on Blockworks, I was speaking to the guy a couple weeks ago, and he sent me a copy of the report from the FHLB. And for listeners out there who aren't familiar, this is kind of a hidden emergency liquidity area or zone, kind of an emergency lending vehicle that the banks use to avoid borrowing from the Fed's discount window. So a lot of short sellers, a lot of hedge fund managers, people that would normally looking for short selling opportunities for shares are monitoring the Fed's discount window to see which banks have to do emergency borrowing from there because it's at a slightly higher penalty rate. So what John Titus said is that prior to a major banking crisis, you have these banks that will have big spikes in borrowing from the FHLB to avoid going to the Fed's discount window. So we've started to see that. He said it started before Silicon Valley Bank, but the spikes in the FHLB now are way above trend. The last report we had, which was at the end of April for 2023, it had in their lead that the spikes in borrowing from U.S. banks, and these are banks of all sizes, hit a record higher than 2008 at over $1 trillion in borrowing from the FHLB.
And what's the advantage for these banks, for the listeners, to going there instead of the discount window to borrow?
They don't have to report as much of it. So the FHLB is what issuing a report, and I don't think, unless you're John Titus or you're a short seller at a bank or a hedge fund, I don't think the average person is going to have time to go through all the reports and see the banks declaring where they're borrowing from. So I think there's a lag there. It's not whereas like with the Fed's discount window, if a bank starts borrowing from there, you kind of know pretty quickly it gets around, but you hardly hear anyone talking about banks borrowing from the FHLB, and no one's naming specific banks really.
So it's basically just they're hiding their troubles.
Yeah, the banks are known for this, unfortunately. Yeah. So whether it's a leveraged hedge fund trade where the banks got in trouble during the last Fed rate hiking cycle in 2017 and 2018, that Jerome Powell was also Fed chairman back then, and he helped cause the repo crisis. So the banks were borrowing from repo then too, and then they got caught with their pants down and they couldn't pay back the money they borrowed from repo because the risk parity trade blew up, and a lot of banks had on a lot of leverage bond trades then, and the leverage short volatility trade that also blew up then too, that's according to volatility hedge fund manager Christopher Whalen of Artemis Capital, that's over $3 trillion in size. So you have all these leverage trades on, and during a Fed rate hiking cycle, the banks are always looking for a new, besides the Fed's discount window or an emergency quantitative easing program, the banks are always looking for a new liquidity pool or borrowing facility to borrow from that they don't have to immediately report to the market. So the average person doesn't understand everything that's going on. Meanwhile, you have all the officials, right? So the Fed is just marching out lots of Federal Reserve Bank chairmen, Janet Yellen, Jerome Powell. The banking system is sound. The financial system is sound. There may be a little problem in commercial real estate, but we don't think it's that serious. But there are some warnings here. Normally it's from, and this is like this at many government agencies, Lee, it's from the person who leaves the government, and they're more open to actually talking about the truth. We just got a pretty big warning. I'll pull up the article here in Bloomberg so I get the guy's name right, from former Dallas Federal Reserve Bank President Robert Kaplan. And he said the bank pain is just getting started. Ex-Fed President Robert Kaplan says that the Fed will do a pause. So they will take a break on the rate hikes. But the problem is that everyone's Microsoft Excel spreadsheets and models for assuming cost of capital, for assuming interest rates, for borrowing, it does not work in an inverted yield curve environment, and it does not work where the Fed rapidly raises interest rates from close to zero to almost 5% or something like that. I can't remember. I don't have the yield curve in front of me. You could probably pull that up on very quick.
Yeah, it doesn't look pretty. I looked at it before. One thing that we talked about, but I don't think we mentioned on the show yet, is the insurance companies. I mean, there's an article on Motley Fool right now, and they're sitting on billions in unrealized losses. So,
I 100% agree. We briefly mentioned it, I think, for all of like 20 seconds, 20 minutes ago. So okay. Good memory bringing up that article. I think the insurance companies look Lee, the insurance companies, what you're going to hear the Fed apologists say, what you're going to hear the mainstream the people on the mainstream financial media, the regular bank stock analysts who are not Austrian school, who are not libertarian, what you'll hear them say is that these banks or insurance companies, they can just hold the bonds to maturity. Okay, in theory, they can, but go back and listen to, only in theory, go back and listen to what former hedge fund manager Brian McCarthy was talking about last week on my interview. And he basically said this hold to maturity stuff is accounting fiction. So it's only good if the entity that's holding to maturity either does not have to adhere to generally accepted accounting principles, or they do not have a balance sheet problem and do not have to go to the market and go to new investors who, so to fix your balance sheet, if you're a publicly traded company, normally you need to either have debt for emergency situations, or you need to sell shares for cash. So that's called raising equity. So if you need to do emergency capital raises for an equity injection, the potential new investors, if they're asking halfway decent questions at all, are going to say, mark to market your losses. We want to see your balance sheet right now. And that's the problem that the regional banks got into, is they had all these problems with losses on bond portfolio. First Republic was underwater in their jumbo mortgages that they had given out at 3%, their jumbo mortgages, long-term jumbo mortgages, and they had the depositors fleeing. So all these different problems, well, obviously the bank needs to go raise capital because they're not getting depositors in, and the bank needs to go raise capital, equity capital. And then the investors say, ask for the balance sheet. They see the balance sheet with the updated bond losses, and they say, even if we put in the equity capital, we're going to lose tons of money. I mean, look what happened with the Saudi pension fund. I think the Saudi pension fund, their sovereign wealth fund, put in many, many billions of dollars into Credit Suisse. And within about under 6 weeks, Lee, I think their losses were, they had lost many billions of dollars. They were down like 95%.
They just need to crank up the oil pumps more and they'll make it back, right?
I don't think the Saudis want to produce more at lower prices. I think the Saudis would cut production more than increase production at this point.
Yeah. We talked just a little. Let's just finish with the equity markets. You look at the NASDAQ 100 and compare it to the Russell 2000. The market breadth just sucks right now. It's only like a small handful of companies that's driving this last rally, which is not a good, healthy market sign. So it's going to be interesting what happens over the next couple of weeks.
Well, actually, one more thing I want to bring up before we end this show. So I want to bring up gold and silver and the mining companies. Okay. So we've had mining company, gold and silver miner earnings the last week or two. And in general, a lot of the earnings were pretty good. So your Agnico Eagles, your Lundin Golds, your B2 Golds, those are the top performers for gold miners. So Agnico Eagle, Lundin Gold, B2 Gold. If you have to own any gold miners, and honestly, I don't really like any gold or silver miners long term. These are not companies you want to just buy and hold in your retirement accounts. But we had in the last 10 days, we had Newmont Mining announce earnings, and I was just shocked how bad the numbers were. And then the management team just nonchalantly brushes away how they didn't earn any free cash flow at gold prices almost over $1,900 an ounce. So they had an absolutely horrific quarter with higher costs at their mines, with capital expenditures at their mines. And the management team just nonchalantly at Newmont Mining just brushes it aside and makes it like, oh, our costs are going to go magically right back down to $1,200 an ounce. Wink, wink, nod, nod, and you should just trust us.
It's just one sector I never liked. I don't trust the stocks. I like the precious metals, but I never trusted the stocks. I've had I've had a few good successes trading them, but investing them, I would never do,
And all you have to do is go back and look at a max chart from 1985 to present on one of those global macro websites of Barrick Gold. I mean, it was only up from 40 years, over 40 years. It was only, or just under 40 years, excuse me. It was only up a couple years and then the management team screwed it up with billions of dollars, tens of billions of dollars in bad acquisitions and write-offs and higher costs with mines, not being able to maintain profit margins. And here we go. So we have the Newmont mining management team saying that don't worry, our costs are going to be back down to $1,200 or $1,300 an ounce soon. Wink, wink, nod, nod. But they're also going to be paying, I think, over $19 billion for this acquisition of Newcrest Mining, which is a large gold and copper miner in Australia, one of the largest, if not the largest. Well, Lee, this is adding a lot of extra costs and a lot of extra copper exposure to Newmont. So Newmont's like their capital expenditure bills, and this is the problem with all mining companies. So the main problem with all mining companies is capital expenditures, which hurt their profit margins and their free cash flow.
And I don't care what you say. There's no way they can forecast, especially in the environment we've been living through the past few years. Their capex expenses going up, in the next couple of years, because there's so many factors, that the cost of fuel and everything else, that there's just no way that they could say we're going to go back down to whatever it is announced, $1,200 an ounce. I think is what you said. Would you agree?
Well, Newmont listed, this wasn't their earnings report last week. This was their one a couple months ago. So from Q4 2022, so that came out earlier this year in 2023. They listed that on itemized expenses for their costs, that labor costs in emerging markets are 50% of their costs. So if you're in another currency that's not the dollar, those currencies are falling even faster. So yeah, we're hearing the deflationistas talk about deflation, the M2 money supply is collapsing, banks are not lending. Well, obviously, a lot of the banks aren't going to lend if they have all these problems that we discussed. So what is the Fed going to do? I mean, even if the Fed does a 180 rapidly and rapidly lowers interest rates and starts quantitative easing, I think a lot of the damage is done because these banks, and Christopher Whalen has talked about this is the top mainstream bank analyst out there. I mean, this guy is super well respected. He's not Austrian school. He's not been saying for the last 10, 15 years about hyperinflation immediately. He's normally pretty conservative, and normally he's very reserved on a lot of his comments. He's talking about how the FDIC reports, their numbers say the banking system is insolvent. He's talking about the banking system is sitting on trillions in losses. And he's talking about why the banks can't lend and the banks need to do emergency capital raises.
Yeah, I think one thing that came out in the news, I think it was today, and this is someone I always have followed, is Stanley Druckenmiller. He's talking about an imminent recession. So I think we're about to see some of the shoes that we've been talking about drop hard.
We really haven't seen large institutional demand for physical gold yet. So we've seen the gold bull market, I would say, restarted about 6 months ago when we started to see the data come out from non-G7 central banks. They had finally started to absorb all the crazy stuff that the US federal government had done with the sanctions on $300 billion in the Russian foreign exchange reserves. So these non-G7 central banks have just been almost every month buying more and more tonnage of physical gold. If you compare the numbers from the World Gold Council, what central banks bought in 2022 versus 2023, I think it was up 4 or 5 times the amount of tonnage.
Right. Well, what I was going to finish with though is,
but
Druckenmiller is
you brought up Druckenmiller. That's the institutional. So these are the big players. They own almost the big institutional investors, the big hedge fund managers, as a percentage of their total assets under management. They own almost zero gold.
Well, I mean, he's lukewarm on it, but Bridgewater sees a long run up with gold. So it's kind of interesting. There are 2 big players in that space.
Well, I'll tell you who's buying a lot of physical gold, and it's because they don't have a lot of investment options with the capital controls in China, with Chinese property values falling, Chinese stock market. A lot of those tech companies and consumer discretionary companies are firing lots of people. There's not as much discretionary spending. There's rumors of a big currency devaluation coming soon of the Chinese yuan against the dollar, fairly big, with all the problems and all the banking system shenanigans in China that started in really they got out of hand in 2018, 2019, before the pandemic even. And they've only been, with falling real estate prices and problems with the developers made even worse, is the amount of physical gold tonnage that is going from Swiss gold refiners for private sector Chinese demand. I mean, we've seen, according to the data from Reuters, and so this is not kind of sketchy Chinese Communist Party data. This is data that Reuters is tracking from Swiss government, from Swiss exports into mainland China. Over 500 tons of physical gold went to private sector Chinese demand, I think since October. Now, I'm trying to get a Swiss gold refiner that has worked at one of the major Swiss gold refiners to come on for an interview. I've been sending emails to my friends who run gold bullion companies in Switzerland, trying to see if they can arrange to get me an interview with a Swiss gold refiner. The last time I saw one of them doing a public interview was back in 2015 when Jim Rickards got one on. So from what I've heard, from what my sources who are gold dealers in Switzerland are telling me, is the refiners really don't want to make a lot of public comments, that they'll just kind of comment on the export data of all the physical gold that's being melted down into 4.9 kilobars and sent to mainland China.
Interesting. Well, I hope you can line that interview up. It's certainly something I would be listening to.
Yeah, I'm doing my best. I sent out quite a few emails already. We'll see if it can happen before we get to the 10 million views milestone. We're almost at 10 million. For our listeners who aren't familiar, haven't been paying attention, I'm finally almost to the 10 million views milestone. It'll probably happen in the next month, 4 to 6 weeks.
Fingers crossed, and hopefully this episode helps.
Yeah, well, we're under 30,000 views left, so I don't think this interview with the YouTube censorship is going to get 30,000 views, but, you never know. That might be nice.
It would be. So, Jason, it's been great talking to you as always. I look forward to the next episode. Hopefully we'll have some better things to talk about, like in terms of positive.
Unfortunately, I see.
I don't think so.
Well, at some point, I can't give an exact date on this. The Fed's definitely going to pause on the interest rates increases. So I don't know if they're going to pause a couple months and then do another rate hike, or they're going to pause and then do a 180 and start cutting. But the listeners need to understand that all these private companies, so if you're a publicly traded company, you're a real estate company, a bank, you can't really deal, because it's a Pavlovian response. You were taught by the Fed for almost 15 years that to expect interest rates close to zero. And then the Fed did a rapid interest rate increase. And now a lot of their, all their formulas, their mathematical formulas with their Excel spreadsheets for cash flow projections, interest payments on the debt, especially for commercial real estate, because this is just the first inning. And from what I'm hearing, the problems in commercial real estate in the European Union are imploding even faster than in the US. My banking contact who I spoke to on Tuesday, he actually said that Deutsche Bank is probably next. he said, and we know that Deutsche Bank has had so many problems really since 2008, and they've been getting away, Lee, for years with just doing reverse stock splits and then getting smaller bailouts and selling enormous amounts of new shares at like a 10% discount to the market price to pension fund suckers. I don't think Deutsche Bank can get away with these games and that shenanigans for much longer.
Well, stranger things have happened, right? we'll see what happens. When we were talking about Credit Suisse, a few months ago, so we were ahead.
We were warning about Credit Suisse. How much we were warning about Credit Suisse months before anyone else. I was told by hedge fund people back with Archegos that it was going to be a problem. No one was listening. No one was paying attention. I guess a few hedge fund managers were starting to line up their trades, but. Sounds like Deutsche Bank may be next, though, for European banks. And then obviously...
Have you heard anything about RBC, Royal Bank of Canada? Any rumors on them?
I haven't heard anything. I know HSBC Bank had to panic sell their Canadian assets. So there's rumors about HSBC Bank, which wouldn't surprise me because they have a ton. I don't know the exact numbers, but they have a ton of exposure to commercial real estate and residential real estate and construction companies and real estate developers in the Pearl River Delta. I was going through their old annual reports of HSBC Bank, and they were bragging 2013, 2014, 2015, 2016 about all the branches they were opening up in the Pearl River Delta and exposure to Chinese real estate. But they never actually put exact numbers on that stuff in their annual reports and investors presentation. But I imagine HSBC, so other than maybe Deutsche Bank, I would probably say HSBC has a lot of red flags there.
I guess time will tell.